Welcome, everyone. Well, it's Friday, May the 1st, and I am very encouraged to see how many people have joined us today for Dr. Peter Andersen's economic update. On the screen, you're going to see all of the upcoming webinars for next week. So I encourage you to log in and see and get some new insights on some very good topics. On Thursday, David Coletto is a data analyst, and he's been watching all of the trending data as to what people are purchasing, what their reactions are. So that's some really fascinating information that will be useful to you as we look at the potential of a rebound or a reopening here in Canada. So our guest presenter today is Dr. Peter Andersen. He is an independent consulting economist. He obtained his PhD in economics from Harvard University, and then he worked at Canada's version of the US Federal Reserve, our Bank of Canada. He was the director of its economic forecasting team. Then Peter joined the national management consulting firm of Woods Gordon, which later became Ernst Young. He was the managing partner for the business conditions and forecasting practice. To many of our tech members, Peter is well known because he has been publishing the Andersen report, which is routinely sent out to all of our tech members. I would also like to say that Peter was also instrumental in covering and providing a lot of information to major corporations, financial institutions, and buying groups. He's still very involved in presenting to various sectors and providing that information on investment management, portfolio management, insurance, financial planning, human resources, and various other sectors, including home building, retailing, and trucking. So without further ado, it is my pleasure to welcome Dr. Peter Andersen. And what better day than May the 1st for an economic report? Hi, Peter.
Hey, Ruth Ann. Thank you very much. Thank you very much, ladies and gentlemen. It's a great pleasure to be able to speak with you today. There will be, I'm sure, far more questions than I will have answers for. Please feed those questions into Ruth Ann, and I will try my best to answer during the wrap-up session. And if you think of questions after we're done today, well, let Ruth Ann know, and I'll get back to you through her and answer anything that occurs to you later in the day or over the weekend. Anyway, congratulate yourselves. We live in incredible times, such an interesting world out there. That's putting a positive spin on it. You know, we haven't seen anything like this in our lifetime. This truly is a lifetime experience. And in terms of trying to describe it, models just can't do it. And that's what, in my area in economics, we've relied on for the last 50 or 60 years. We've relied on modeling, trying to predict behavior in the future on the basis of past relationships and past behavior. We really can't do that today. So when it comes to forecasting, everyone, I am certainly humble. I am certainly cautious. I don't want to give any impression of false precision. False precision. You see, if you look at a forecast that has numbers and decimal points and percentage points, that's a quantitative, hard edge type of forecast. And I'm sorry, but my profession just can't do that today. We do our best. You do see some forecasting agencies that do put out specific forecasts, but in many cases, in most cases, in fact, I would say perhaps all cases, all they are educated guesses. And of course, models are in themselves educated guesses, but this time around, I think the guesswork is quite more prevalent. So what I'm going to say is that what I have in terms of my crystal ball, it's a qualitative type of comment. It's a qualitative view. it's based on the part of my mind that is really, I guess it's more along the lines of intuition. It's not kind of a forecast that involves lots of moving parts and lots of precise equations. It really is more of an intuitive, opinion-based view that I'm going to express to you today. So false precision, we're not going to do that. However, in terms of orders of magnitude, it looks like this recession, it looks like the peak to trough movement in this recession is going to be about 3 times the great financial crisis. So in terms of peak to trough in the great financial crisis, this is about 3 times worse. And that applies both in North America, broadly speaking, Canada and the United States, and it also applies to the global economy. So I wanted to throw that out to you at the beginning, because some of you might say to yourselves, well, Peter's really just far too optimistic, isn't he? Well, I want to make it absolutely clear what the reality is as of the 1st of May. This is the reality. In terms of oil, for example, very important for Canada, the International Energy Agency has estimated that world oil demand in April, the lowest since 1995, the lowest since 1995. So anyway, this certainly is a different kind of recession. It has come on us so quickly. It has come on us so quickly. I was saying to Ruth Ann that I was making a presentation not that long ago at the beginning of March. I happened to be in New Orleans, of all places, and I did not see this kind of situation developing at that time. At that time, the word containment was in the air. We thought that the C-19 could be contained within China, within Asia. We didn't see it spreading to the community in North America. And I felt that we had this firewall, that we could contain it. I did have this uneasy feeling, though, that it could get into the community. And if it got into the community, then we'd have to do the social distancing. And I did at that time say, well, that would be a whole different matter. It would be a different ballgame if that happened. And the word asymptomatic is really the key to it. This virus spreads so quickly because of its asymptomatic character. SARS was not like that. I remember living in Toronto during SARS, and what a period that was. But SARS did not spread through asymptomatic transmission, whereas this time around it's different. So it's so different, and it's so deep, and it's come on us so quickly. Anyway, that's my introduction. Lots of questions coming. Lots of questions. My answers, well, I'll do the best I can. So this is basically what I'm going to cover today. When and how is this all going to end? What are the indicators that I'm watching now? And I have changed. I'm watching different indicators. Is there any good news? I always want to try and be balanced. We're getting plenty of bad news today. To putting out the negative spin on what is happening. But is there any good news? And then how about the differences and the similarities with the last recession? That's what we call the Great Financial Crisis, the GFC, the Great Financial Crisis, 2007 to 2009, or 2008 to 2010, depending on how you want to measure it. Finally, something that we all think about is, how are we going to pay for this? How are we going to pay for this? It looks like the US government is spending something in the order of at least $4 trillion this year. Hasn't gone up to that figure yet, but I think we're going to see more coming. Globally, it's $8 trillion. that is being put out by governments to try and stem the downturn. How are we going to pay for this going ahead? And finally, you're hearing lots of discussion on what will it be like afterwards, both immediately afterwards and then a few years later, and then the medium term. Don't you love that word, the medium term? What does that mean, the medium term? You hear it pulled out a lot, but basically, what's the new normal? We're not going to go back to pre-COVID, the pre-COVID world. But what are some of my thoughts on what the new world for households, families, and businesses and governments, what is that going to look like? So that's what I'm going to talk about in my time this morning. And I'm going to let you know that right away what my conclusion is. Here is my conclusion after we go through these questions. So this is probably, if you want to leave the meeting now, you can, because this is it. I'm going to get to the point. What I'm going to say is that we hit rock bottom in April, and I am saying that the Western economies, many of them are opening up. They're opening up in Europe. Choose my words carefully, Peter. Opening up bits and pieces, step by step, very carefully staged with lots of conditions. That's what I mean by opening up. But it's happening in Germany, it's happening in Austria, it's happening in Norway, it's happening in Denmark. We are also seeing that in the United States. We have about 10 states that are changing their modus operandi as of today, as of beginning of May. Again, small steps, small pieces, and so on. But what I'm saying is that it's not up to me to argue or give the pros and cons of reopening too soon. That's not what I'm going to go into. I'm going to say it's going to happen. It is happening right now. It is happening right now. And it's happening in Canada as well, Saskatchewan and Quebec. So that reopening is happening and will happen. And May is when it happens. April was rock bottom. And I just mentioned to you how low that was and how the bottom that we've seen in April is beyond imagination. So what I'm saying is that the recession ends this summer, okay? The recession ends this summer. Be careful on words, everyone. That does not mean we have a recovery. A recovery means that we get back, or we're heading back quickly to pre-C19 levels. I'm not saying recovery here. I'm saying that the wheels start to turn. And putting that into kind of intuitive terms, percentage-wise, things can be deceiving. Because if you come from an extremely low level of employment or revenue or output, an extremely, incredibly low level of output to something somewhat higher, the percentage increase can look big, very big, because you're coming from a low base. The thing is to look at the absolute level of change, okay? Look at the absolute increment. It can be quite small. Of a V-shaped recovery, that's a bad word to use, a bad phrase. Yes, it might look like it's V-shaped in terms of percentage terms, but in terms of absolute terms, in terms of the actual size of the increase in employment and in output and incomes, can be quite small and quite modest. But I'm saying that we come out of this decline in the summer. And I'm also going to make the statement that I think the economy can continue to gain altitude, can continue to increase before a vaccine is developed. Okay. Again, these are kind of basic fundamentals that I want to deal with. Uh, Dr. Anthony Fauci is obviously one of the people that has a lot of credibility on this, and he basically assures us that we will see a second wave of infection. But when will that come? It will probably come in the first quarter of next year, which is the seasonal period for flu-like illnesses. But what does that mean? I think we'll be better prepared. It won't be like the beginning of the first wave when we didn't know much about it. Now we do know that about 80% of the deaths seem to be happening in high risk parts of the population. In other words, hey, people like me, people over 65, or people with risky health conditions, diabetes, obesity, heart disease, things like that, severe heart disease, that kind of thing. So if a firewall can be put around these people, if we can limit the deaths and the infections in nursing homes and the congregation of elderly and people who are at risk health-wise, this second wave perhaps can be dealt with. So there you go. I'm saying that with 80% of the people known to be who they are at high risk, perhaps they can be isolated, perhaps they can be protected. I guess I'd also like to say, before going any further, I'm going to make a comment here that actually comes up in one of my slides, that in terms of indicators that I'm looking at, as I know you are too, they're looking at as much data as you can find on the coronavirus. So I'm looking at the Worldometer's website, and I'll give you that URL in a few minutes as we get into that slide. But I don't see any second wave yet in South Korea and Australia. Take a look when you get a chance over the weekend at the Worldometer's website, and take a look at South Korea and take a look at Australia. Look at the curves there, and we don't see any signs of a second wave. Now, I think that with the reopening, or the very guarded, gradual reopening of states in the United States, we are going to see more cases because of this. But I don't think it's the second wave. I just think it's a continuation of the first wave, and it's part of the unevenness getting out of all of this. Anyway, when and how will it end? I'm saying that it is starting to change now, and we're going from declines to increases because we have the opening up of different parts of the United States. The indicators to watch, well, I have moved away from looking at the things that I've always looked at, things like employment and gross domestic product, and retail sales and business investment, because they don't tell me anything I need to know. Of course, they're going to show unbelievably bad news when you completely or almost completely shut down an economy, and you go into the kind of economic shutdown that we've had happen in the United States and Canada, with streets empty, no traffic on highways. Well, of course, the economic numbers in March going into April are going to look absolutely terrible. But a couple of comments on that. You know, in terms of watching the media, I've heard comments like jobs have been wiped out. You know, we've had over 30 million jobs wiped out in the United States. And that number comes from the increase in unemployment insurance filings in the United States over the last 6 weeks. I don't think they're all wiped out. I think that we have problems, the problems being in certain key industries such as hotels, hospitality, and also small business. I think we have a small business crisis here going ahead. And so there's many people who won't return to work But out of that 30 million that have filed for unemployment insurance claims, those jobs haven't been permanently wiped out. And I think a number of them are going to be coming back each month as we go through the summer and into the fall. Other indicators that I like to watch these days are financial indicators. And one of them is the stock market. Now, people sometimes shake their heads and say, oh, the stock market doesn't really tell you anything. It's misleading. It's just a completely random type of indicator. But at a time like this, I think it does tell us something. To me, it's the distilled wisdom of a lot of smart people. And what we have seen, and of course, I like to keep it simple. We all do. So I look at the Dow Jones Industrial Average. I know there's the S&P 500 and there's the Russell and there's all kinds of other measures of stock market performance, but hey, I just look at the Dow every morning, midday, at night to see what close look like. So we're down 10,000 points. We were almost at 30,000 on the Dow around the middle of February at the peak. We were down 10,000 points by the 23rd of March, Monday the 23rd of March, okay? Then down
Peter?
10,000 points.
Peter,
Yeah.
I'm just getting a couple of questions to make sure that you're not moving a slide forward or anything. You're still just on a discussion point because some people think their slides are stuck. The slide is
Don't
stuck.
worry, I'm slow here. I'm still on my slide number 2.
Okay, good to know. Just wanted to
You're
reassure.
Everybody is probably thinking, when is this thing going to be over? He's only on the second slide. We've got all these other slides to go. Are we going to be here all day? Don't worry about it. Don't worry about it. This is the way it's supposed to be. And I have got my eye on the time. I know that it's 11:20 Central Time. It's 10:20 Mountain Time. Don't worry. Don't worry. It's all good. So just to keep going here, when it comes to the Dow, it was at its peak in mid-February. By the 23rd of March, the Dow is down by 10,000 points approximately. Well, since then, it's gone up by 5,000, okay? So we've had about a 50%, bit more than a 50% rebound in the Dow since it got to its low point on March the 23rd. So all I'm saying is that, you know, that's the little bit of good news that's out there, because try and put that in perspective. April was the worst possible month in this particular situation. It's not going to be anything like what happens in May and June, but yet, even with this bad month, okay, the Dow goes up 5,000 points. Now again, be careful. It was on pretty low volumes. We didn't really have resounding volumes of trading on the Dow. So you can say that the recovery is on shaky ground. But the other thing is that baby boomers haven't lost their life savings either. And let me just run that by you. The Dow right now today is at around 24,000, okay? Around 24,000 today. And the low point that I want to give you as a reference point, Christmas Eve, 16 months ago, not that long ago, Christmas Eve, 16 months ago, the Dow was at 21,700. It's above that level today. So you can't say that wealth has been wiped out. You can't say that. In fact, we think that there is a wealth effect if you have a stock market crash, and it's bad news for the economy because people really belt tighten if they feel their wealth has been decimated. Well, as far as the averages are concerned, that really hasn't happened yet. And coming out of all of this, my conclusion that we are moving out of the recession, we're moving out of the recession right now in May and June. Construction is going to be one of the first sectors to get moving again. Construction. and so is manufacturing. But with construction, the stock market is awfully important because stock market wealth has a lot to do with what goes on in the housing industry. Okay, so differences and similarities with the last recession. Well, one of the similarities is that this is global, and the last recession was global as well. But one of the differences is that this global recession is a lot worse than the last one. Okay, it's about 3 times worse. So here's a question for you. Will Canada and the United States be able to pull out of this with the rest of the world in such bad shape? How are we going to pay for it? Well, you know, the kind of natural answer to this is that we pay for it with inflated dollars. But be careful on this, because we've come out of a 10-year period where inflation was almost non-existent for a number of reasons. And just maybe, we're going to find out that inflation doesn't come back, and we're going to have to pay for this through the tax system. And the tax system means middle class incomes and upper level incomes and corporate taxation as well. And the new normal, what's that going to look like? Well, I guess what I would say is very quickly, just-in-time delivery or just-in-time world is probably going to change. And we're probably going to find that we want to have redundancies in the supply chain. We're going to want to have more than one supplier, and probably we are going to repatriate some of the offshoring that has taken place. The future of work, I think, is going to change. A lot of people are going to work differently than before, and that has real implications for real estate, for commercial real estate, and what that is going to look like on the other side. Anyway, that's kind of my introduction. Let's take a look at some of the slides. The Dow Jones, that's the third slide, I guess. Dow Jones Industrial Average. These are month-end numbers, and I just want to make the point that, hey, here we are. We're at 24,000 on the Dow, and that's higher than where it was Christmas Eve, 16 months ago. So there's still a lot of wealth left in people's portfolios. We take a look at the stock market on a month-to-month basis and compare it with 12 months ago. We've been up. The technology part, NASDAQ is actually higher at the end of April than it was 12 months earlier. And things really don't look so bad as far as the stock market. The other thing I'd like to point out to you is that in the United States, the construction industry has been tagged as being essential. And this diagram on construction employment really makes that case. The latest data point, of course, is not April, it's March. And yes, there was a decline going from February to March. But take a look at where you were heading into this worst month, heading into April. Construction in the United States is still in pretty good shape. It still has its footings. Yes, there have been delays, and the delays have been supply chain related, not getting the materials and supplies, and also PPE supplies holding back construction on sites. But nonetheless, these delays do not mean postponements. That's the key thing. They do not mean postponements, and there's a lot of construction work in both countries in the pipeline that is going to be showing more and more results at the ground level on sites very soon. And the other thing is we heard from Federal Reserve Chairman Jerome Powell on Wednesday, and one of the interesting things he said was that interest rates are going to remain low for years, and that means in Canada as well. interest rates are going to remain low for years. And at the present time, the benchmark mortgage rate in the United States is as low as it gets. Okay, that's as low as it gets. It has gone down, and you notice it did have a bit of a spike up. That was in March when it looked like we were in trouble as we got into the middle of March, and then the Fed immediately responded. Do you remember the dates? Friday the 13th, okay? Friday the 13th. Sunday the 15th, the Federal Reserve announced, surprisingly, an emergency policy move to open up its quantitative easing program again. Now, it had a meeting scheduled, okay, for the Wednesday. It couldn't wait for the Wednesday. It did it on Sunday afternoon instead. And then it followed up on the 23rd of March, which was a Monday. It followed up on the 23rd of March by making the statement that its quantitative easing would be unlimited. No ceiling on it. It would be as big as it had to be. And so the market all of a sudden realizes that there's not going to be a shortage of liquidity and interest rates come back down again. Okay, so I think that's a key thing to look at. And since then, the Federal Reserve in the United States, with quantitative easing now completely open, much bigger than the last time around, it's now gone into targeting credit. And we have now 9 different targeted credit facilities in the United States. So the Fed is doing much, much more, and it's doing it much faster. These policy moves in the United States took about 5 to 6 months to get in place the last time around. This time around, they've happened in a period of maybe 2 weeks approximately. So things have happened much faster. Again, even in Canada, we have a positive outlook for construction as we start to come out of this. I think Canada will be slower than the United States in terms of opening up provincial economies. However, I was surprised by seeing what Quebec did this week and Saskatchewan as well. So we'll see what Manitoba does and we'll see what New Brunswick does. But take a look at the building permits here in Ontario. These are commercial, non-residential. That's ICI construction. And this is what's in the pipeline. And these contracts are out there. And this is work that, and you're looking at construction. Construction is really classed as essential in most provinces in Canada, with the exception of Ontario. In Ontario, residential construction is looked at as being essential, but not non-residential construction. In non-residential construction, it's only petrochemical facilities that are, and there's one other thing there. So here is what the Fed has done in terms of its balance sheet. Look on the left-hand side, go back to 2008, and you can see the increase in the Fed balance sheet then came from something like 800 billion going up. But look at the increase that we've seen in April, much bigger. And look at money supply growth in the United States. Money supply growth is headed to over 20%. They are really flooding the system with money. It's like helicopter money. It's like we have helicopters overhead dropping down $100 bills in the United States. So this is not necessarily going to give us a strong recovery, but hopefully it's going to protect us on the bottom end. And hopefully this is a firewall that is going to prevent the business failures that are inevitable, the bankruptcies that are inevitable, and the loan defaults that are inevitable from cratering the financial system, okay? So all of these moves are up there, and the idea is that the banks will be safe. We're not going to have that Jimmy Stewart movie, It's a Wonderful Life, with people lined up to take money out of the banks. And this is important because back in 2008, we weren't sure. We weren't sure about banks, and we had a number of banks that had to close their doors. Investment banks, of course, but we had other mergers that were forced mergers as well. Here's what the United States government is doing in terms of spending. And the numbers right now, you're up to about $3 trillion in direct support payments by the United States. It'll probably be 4 trillion plus by the time it ends. That's 20% of gross domestic product, 20% of the economy in this extra spending by the Federal Reserve, by the federal government. And that's twice the stimulus that was put in place the last time around. So keep your fingers crossed. We have going into all of this, take a look at business order bookings for capital goods going into the end of March. Well, surprisingly stable. A little bit of good news there. Obviously, it'll be down in April and May, but a fairly good starting off point. This is one of the problems for Canada, though. We have a couple of made in Canada problems, and one of them is our household debt position. You can see that Canadians have really been piling on debt since the last recession. We never really did show a decline in household debt relative to the economy as a share of gross domestic product. We have to do that, you know, because the household debt numbers have to be looked at in kind of a relative way of measurement. So as a share of the economy, we're up to 100% now in Canada, pre-COVID. How about the United States? Well, they've been declining steadily, okay, since the last recession, and they're down to 70%. So we are vulnerable when it comes to household debt in Canada. We are. So that gives us all kinds of vulnerabilities. Okay, we have a lot of home equity loans. Okay, we have a lot of people who can't pay their rent, and we have a lot of condo owners that are in trouble. We're already upside down in their cash flow, and they're hoping for capital appreciation. So we've got particular vulnerabilities in Canada in the real estate area. And then, of course, with oil. I would make the broad statement that in Canada, the small oil and gas companies were already on life support before we had the COVID-19 crash. And so this diagram has to be updated really on a daily basis almost, but what it shows you, broadly speaking, that the benchmark Canadian heavy oil price, the WCS price, well below $10 a barrel, and that is a crisis level. So what is going to happen to Western Canada? What is the government's response going to be? I'm still waiting to see that. I think what we have on our hands here is a problem that isn't going to go away. I think we are going to see a huge amount of consolidation take place. And some of that might be government-supported consolidation in the oil and gas industry in Canada. Now, in terms of the key indicators, of course, we really have to put our first job, number one, is to look at the virus data. This diagram on U.S. daily confirmed cases, it comes from Johns Hopkins. And it shows you that while the numbers, the trend isn't going up anymore, it's not obviously going down either. It's a 5-day moving average, and we're running at around 30,000 per day in the United States. So it's much different from, let's say, Australia or South Korea. And I've got a couple more charts here. Let's take a look at these. And this is the link that I wanted to mention earlier, the Worldometers link, worldometers.info/coronavirus/country. And you can look at different countries. And so in terms of daily cases, this is not a moving average. You can see that it's still not showing the kind of move that you and I would like to see in terms of number of daily cases. And then you can see Canada, and Canada is really not showing any decline either. But look at South Korea. Look at South Korea and look at Australia. The good news is that there has been this shift to much lower numbers in terms of new cases, and we have not seen any sign at this point of a second wave, even though South Korea, as you know, has opened up. So we're almost done here. The world economy, I said earlier that be skeptical about numerical forecasts, but I'm showing you one anyway. This one comes from the International Monetary Fund, and it was the forecast that they released around the middle of April. I think it was around the third week of April. And they're showing a decline in the world economy of 3%. Well, take that with a grain of salt, but the point is, what is the message? The message is that's far, far, far worse than the last time around. And this diagram makes this case. So we're left with this question. Is it possible? Is it possible with the global economy far worse than in 2008? Is it possible for Canada and the US to crawl back on their own? So that's the question, and I'm saying yes, I think so. But again, here we are, it's the 1st of May. We'll see what my story is, the 1st of June, the 1st of July, the 1st of August, and hopefully it's not going to change. Global oil demand, as I mentioned earlier, we have gone to historical lows here on global oil demand. And this is something that doesn't seem likely to get back to what you would call normal or pre-C19 levels for a long time. Because even if we do, under the best case, get a vaccine within, let's say, 12 to 18 months, and let's be really optimistic and say 12 months, which is very controversial, who's going to want to fly for a while after that? Who's going to want to do that? Global air travel and global shipping look to me as if they're going to remain depressed for some time. So the oil price looks as if it's going to be depressed as well for a long time. Now, there has been a bounce in oil prices in the last 2 days, looking at both Brent and West Texas Intermediate. But I think this has been more of a psychological thing, because guess what? As you begin to open up retail stores in parts of Europe and also in the United States, and it will be happening also in Quebec, you are going to get people driving their cars again. My car has been sitting, gathering dust in the driveway for about 4 or 5 weeks now. In fact, one of my things to do this weekend is to wash it. But yes, you will see a reaction in terms of gasoline consumption. And that's what we got in terms of news this week, that, yeah, there was an increase in gasoline consumption in the latest week. That seemed to have a bit of an impact on core prices for crude oil. But my view is that this is going to remain a problem and an issue for some time. One of the things that does surprise me, everyone, is that the price of copper has held up as well as it has. And that's one thing I wanted to leave you with too. Take a look at some of the lows for the copper price in this diagram. And that seems to suggest that China is coming out of its problems. China is always linked to the price of copper. Copper is looked on as being an indicator for the Chinese economy. They're the biggest consumer of copper. And so this is a good sign that the copper price has not been tanking. as it has in previous cycles. And this does seem to say something about the Chinese economy.
While you're talking about copper, Peter, can you comment on gold? We've had a few people ask about that.
I will comment on gold. And I guess my comment is that it's not a clear-cut story. Gold has been always something you buy for panic insurance. And it's interesting, what happened to gold is that gold actually sold off at the beginning of this crisis because it looked as if we had a liquidity problem. And people who owned safe investments, such as US Treasury bonds or even gold, they were selling these very safe investments in order to get liquidity. And then on the 15th of March and on the 23rd of March, with the Fed in the United States, the US Federal Reserve, saying it was going to go all out in terms of creating liquidity, the gold price has gone up again. Now, the issue really is, though, do we need protection from inflation because of what's going on? Gold is typically something that protects you from inflation. And it's hard to see that we have an inflationary world for the foreseeable future of the next couple of months, the next year or two, or maybe three. And it's not until we get out into the middle of the decade that we start to see inflation coming back as a problem. Because I think we'll still have all this debt that has to be paid off, and it very well could be that governments deliberately cause inflation in order to help them pay off their debt. But having said that, Ruth Ann, here's the end of my story. I'm saying that we do not get back to anything like a normal economy until the middle of the decade. So when I say we're coming out of recession, I'm not saying we're recovering. We're not recovering to anything like where we were pre-C19. You don't get back to a fully employed economy until the middle of the decade. And that's really when you need to buy gold. So I would caution anybody who's thinking, okay, it's a good idea to jump into gold. It's going to protect me. It's going to give me speculative returns. It's more complicated than that. I actually did have some gold and I sold it, but don't take that as being good advice. I'm the worst person around to advise on when to buy and sell stocks. Good question, Ruth Ann. And thanks, that got me into my final point as to what the new normal is going to look like. So that's how I'm finishing off here in terms of what the questions are. And so many questions, so few answers. But we're moving away from a just-in-time world. The future of work is changing. Real estate preferences are changing. And having said that, do you really want to go into an elevator in a condo and go up 20 or 30 floors with a bunch of strangers? It very well could be that real estate preferences are going to change away from density living. That maybe people will want to live in low-rise units that have a certain amount of separation from the people next door. So that's one of my thoughts. The other thought, of course, is universities and cities, municipal governments. I think universities are going to be hard hit by this. You really want to spend all those dollars going to an expensive university and having that university experience, pay for your dormitory, pay for all your meals living away from home. I think a lot of people learned that they can do the online learning and they don't have to move away from home. So there's lots going on there. How about professional sports? Are professional sports going to be something going ahead that are really done in a basically a TV studio with canned you know when you're hearing a canned laughter, it's on an audio file. So crowd noise, that's basically artificial crowd noise, and you don't see the empty stands, but the players are out there on the field. Is that the way we're going to go to a new world of studio type of entertainment? The small business, I think, crisis is going to continue. There are so many small businesses that are going to go out of business that won't be able to get back. And because of that, I think we're going to see a slow recovery. Yes, we are going to see, step by step, more people working each month, more people working. That'll happen. But a lot of people really won't get back because of the small business crisis. And then there's the whole issue of the vaccine. Are we being too optimistic thinking that we'll have a vaccine next year? Well, you and I as individuals and you and I as business people are all going to be very cautious with our business planning until we know we have what you would call an end game. An end game. An end game is when we've got a vaccine. We've got a vaccine, we can get our shots, we are going to feel protected, and we can get back to normal routines. But until then, businesses, in terms of planning and decisions and the business way forward, businesses and individuals are going to remain very cautious until that vaccine happens. So again, that's one of the reasons I think that this comeback is going to be a slow comeback, and probably will have confidence cycles, because if Fauci is right and we are guaranteed to have a second wave, hopefully we can manage that second wave by putting a firewall around the 80% that are really high risk, where most of the deaths are. Well, that means the second wave can be managed, but we won't know that until we go through it. So I think there's going to be lots of waves of confidence coming back and then confidence falling to the wayside again. So I think that is one of the reasons I'm saying it's going to be an uneven type of recovery. But let me finish off on a good note, and I'm saying that construction is going to be one of the sectors that is going to be showing progress this summer. And one of the reasons is, and I want to point this out, is that the CARES Act, that 2.3 trillion federal CARES Act, it has a big component for those homeowners who are stressed and cannot make mortgage payments. Of mortgages in the United States will allow forbearance. Okay, now what I just say, forbearance. I did not say forgiveness. I said forbearance. The forbearance means that homeowners with mortgages can be free from paying for 180 days, and they can apply for a full year as well. Now, in terms of the other side, if they want, they can make a lump sum payment to make up, or they can have their mortgage reconfigured, and they can have the payments, the deferred payments, made up through amortization or through lengthening the term of the mortgage, putting another 6 to 12 months on the term of the mortgage. So this means, this is really important, everybody. This means this forbearance from the CARES Act, it means we're not going to see a foreclosure crisis. And that means we're not going to see a crash in housing prices. And this is in the United States. And if it doesn't happen in the United States, we don't have that strong signal in Canada. Uh-oh, look what's going on in the US, a foreclosure crisis, house prices crashing. It's just like 2008, 2009 all over again. No, it's not. The CARES Act means that we're not going to see a foreclosure crisis or a house price crash. I know prices are down right now for house prices in the United States, but they're not going to crash. They're not going to crash and cause a crisis the way we saw a crisis back in the great financial the GFC. Anyway, I think Ruth Ann, I think I'm about done here. I have a few other things in my notes, but
Sure.
I think there are more details that really don't need to be brought up at this time. So, Ruth Ann, I'm going to give it back to you if you'd like to.
We
If
do
you'd
have
like,
some questions. Yep.
yeah, you'd be the quarterback here, and let me know what some of the questions are, and I'll do my very best. I'll do my very
So,
best to.
yeah, exactly. They're going to want you to pull out your crystal ball on a couple of things here, Peter, and really more about the variation in sectors. For example, there's quite a few questions about the travel industry and its dependence on oil. So what might be some of the variation or predictors that you have around travel and airlines, et cetera?
Well, I guess I have to go back just to my own personal experience. We're going to drive more. We already did that. I had a commitment to be in New Orleans for several days at an industry conference at the beginning of March. And I thought I was being, what can I say, a little bit weird by saying, "Hey, I'm not going to fly." We drove 1,200 miles there and back from where we live to New Orleans. And where are we heading on our next trip? We're not flying anywhere anytime soon, even if it were allowed. We're probably going to drive. We're probably going to drive. And where are we going to stay? We're going to stay at places where we think we can be basically isolated from the rest. So, Ruth Ann, our next trip, we're going to the beach. We're going to the beach in South Texas. Okay, outside of Galveston, about 40 miles outside of Galveston, long strip of beaches and beach houses. And the beach houses they're separated. There's the one next to us is a couple hundred yards away on either side. So that's where we're going to drive to. And I agree with that question. I think that the whole airline industry is going to be in very rough shape, very rough shape indeed. And I think the people are going to be reluctant to make bookings until well after a vaccine is developed. It's great to have these therapeutic drugs that are repurposed drugs that are going to cut down on the amount of days we spend in hospital if we get it. But hey, that's not good enough. We need the gold standard. We need the vaccine. So it's going to be a long time, and there's going to be a lot of financial distress that we haven't even heard about yet with the hospitality.
I was just going to say, what I'm hearing is, yeah, hotels, hospitality industries, many of those things are going to be, I mean, if you are a weather bell for what a lot of people are feeling, I think, and you are, there is going to be some impact on that for sure. A question came in from Javier.
Well,
and
it's interesting because if I'm driving somewhere, I'm going to probably stay at Motel 6 instead of staying in a large hotel where I have to get in an elevator as well.
Exactly. So a question came from Javier, and he's just thinking about, again, is this a good moment to buy a company that might be in difficulty and build it from there? Or is that a bit of a risk investment at this point?
Could be. That could be an opportunity. But remember, cash is still king. I think, and it's going to continue to be so. And so that means you don't want to expose yourself financially to any unexpected risks. It's one thing for me to give an opinion on the economy. And what I'm telling you is the economy can grow again, even without a vaccine. However, if we do have a second wave of infection that is truly disruptive, well, then we're going to head into a much worse situation in 2021. So why jump the gun? Why jump the gun? I think myself personally, I think it's time for very conservative investment decisions with financial investments and also with business decisions.
A question came in. You talked about the recovery coming sometime in the middle of the decade. So are you talking 2025 or what's your prediction
Roughly
on?
speaking, no, Ruthann, I'd say 2025. That's when I think the economy will be back basically to full employment and full utilization. I think the economy will look very different. I think that there are many structural changes that will take place. I think that we could be more and more moving towards some kind of a guaranteed annual income. I think we're going to be moving into kind of a different social contract with Canadians and Americans. I think the role of government is going to be much bigger. And I think that the kind of the income distribution is going to be shifted partly through tax increases on upper income people.
And I think you've just leaned into a question that's come up from Susanna in this. Will this crisis be a reason for the global system to change from global to more national structures, or do you see a reversal on that?
I think borders are definitely going to harden. And I do think that outsourcing is going to change. I think that the whole supply chain, the global supply chain is the risks involved in this. For example, just with pharmaceuticals, don't we all wish we still had Connaught Labs again in Canada? We've heard such a high percentage of critical components that go into pharmaceuticals come from China. Wouldn't it be a good idea to have redundancy, even if there's a cost to pay? So the repatriation of offshoring, I think, is going to be something that is going to happen. And again, we're going to have a real shakeup, I think, because coming out of this, global recession is going to be so deep that it's going to be harder to get out of for the developing world. And I think that's also going to be an issue. I suppose, too, with the severity of the situation, you have the whole issue of civil unrest as well. And does civil unrest extend globally? And what does this mean in developing parts of the world? Geopolitical shocks and so forth. So that's something for the intellectuals to get into, the political scientists to get into. I'll just raise it as a topic.
Excellent. I've captured a few more questions, and what I'll do is I'll send these to you afterward, Peter, because we are now right on the hour for letting people go back to business and carry on and make the economy as good as they can make it. So I want to thank you again for your insights and your thoughts, and you know, the data that you did present, it does clarify a few things and gives us an idea, at least at this moment in time, as to where we might be going. And before we started, I said, Peter, I'd like to have you back in September, and I think that if you're open to that, we'll have Peter back in September to say where we went from here and where we'll be at that point.
Well, that sounds like a plan.
All right. I want to thank everybody for joining us. This recording will be available as well as Peter's slides on our techcanada.com website. You will find it under COVID-19 Insights. Click the tab and you'll see that there will be 2 drop-downs and one of them's webinars. So I hope that you will be able to access that and send that off to anyone else and to review what Peter has covered today. Please have a great weekend, and I hope that some of you will join us again next week for another amazing lineup of daily webinars. And in the meantime, have a good weekend, everybody. Take care. Bye, Peter.
Bye.